You work hard to provide for your family today and tomorrow. But if you're like most people, figuring out how best to provide for tomorrow can be a confusing proposition. Personal finances, especially investing for your family's future, is one of the most challenging and often intimidating tasks one has to deal with. How do I create a financial plan? How much will I need to retire? How do I save for college? These are just a few of the questions that a professional investment advisor can answer.
Well, the first thing you have to do is establish goals. Different people have different goals. A younger person may be concerned about getting their college through education. A person more advanced may be more concerned about retirement. But establish the goals, determine what you really want to get out of your investments, and go accordingly from there. That's the first step, is establishing what you really want to get out of it.
Ron Cadu is Chief Investment Officer with Cozad Asset Management, located in Champaign, Illinois. Ron manages portfolios for individuals, corporations, retirement plans, and foundations. He also assists clients with tax and financial planning. Ron's years of experience in the financial services industry have provided him with a wealth of knowledge and a commitment to providing fundamentally sound investing principles and strategic vision.
I think the strategy should be at least 5 to 10 years. Again, it will depend on your goals and what you're trying to do. If you're planning for retirement, perhaps your retirement's 20 years away, but you will want to look at it every 5 to 10 years to see if you're meeting that goal and if you need to make an adjustment accordingly. I think the most basic principle is diversification. I think a person has to have a diversified portfolio. If their portfolio is too focused in one given area and that area doesn't perform for a 3 to 5 year period of time, you can really fall behind and not be meeting your goals. So it's important to diversify among different investment classes. Even within investment classes, you need to be diversified. Asset allocation is the plan whereby you achieve diversification. It may be an investment that spreads among several different sectors of the economy, such as fixed income investments, equity investments, real estate investments. And on the fixed income side, you may even be further asset allocated between bonds, CDs, certain types of bond funds. In equities, you may be further diversified because you have international, small cap, large cap stocks, all kinds of different equity positions that you want to have as part of your asset allocation. But one of the questions my clients normally ask is, how can I eliminate risk or not have risk and still earn 10%? And I tell them it can't be done. There are ways to reduce risk, but I don't think you can ever eliminate it. You can reduce risk by the way you asset allocate, by knowing what's happening in the economy. For example, if we get into a period of rising interest rates, which very well may be happening here in the near future, it may be wise to try and hold your portfolio in such a way that you can not get hurt as badly by those rising interest rates as you would if you were in longer term maturity bonds, for example. Well, I can tell you what's not efficient. We had a client several years ago that had got into a startup company. It was the only stock he held. And this company became more and more valuable, was purchased by another company, and he built up several $1 million of value, but refused to sell because he didn't want to pay taxes. As a result, the company eventually went broke, and he didn't have to pay taxes. I think efficient diversification is having a number of holdings in a given asset allocation sector that you're investing in, and also to not have too many. You can have too many. You wouldn't want 200 stocks in a portfolio, for example, because that acts like an index fund. And you probably want better investment performance than you can get straight from an index. We're primarily involved with the financial assets, which are stocks and bonds and instruments that are related to that, whether it be mutual funds or CDs or other types of investments. But basically, we believe those are the ones that will give you the best return for the least amount of risk, and you can achieve the adequate diversification you're looking for. I'm not a big gold bug. There's probably a place for it for the very large investor to be in a portfolio. A better way maybe to play the gold game is to perhaps purchase an ETF, an exchange-traded fund, which trades in actually the gold bullion rather than going out to own gold. But I'm not so sure that in a tough economy it's the answer. Obviously it's been hot recently and it's done real well, but if we go back 30 years, there was a period of time where gold didn't do anything for a 30-year period of time and you would have lost money. You have to remember when you invest in gold is you do not get any return other than through the appreciation of gold. There's no income being paid on it, so the only return you get has to appreciate. There's a popular commercial out by a company now where you have a number. I'm not so sure that a number is the way to go. I think what you really want to try to do is achieve a situation whereby you've been able to accumulate enough assets that you can retire at a time you want to retire. I don't think everybody has a different number. Somebody may want to retire in a wonderful place and somebody else may want to live in a cabin in Montana, and so which may not cost much money. So I think it just depends on the individual, how much they want to have, and that's part of establishing that goal when you sit down with your investment advisor at the beginning of the process. Tell him what you want to do, where you want to be, so it can help him determine how much you need to save to try and achieve that goal. I don't believe so, unless it's buying the winning lottery ticket, but that's probably not good investment advice. So I think the best way is to continue to look out for the long term of your investment portfolio. It's very easy to be concerned about what's happening tomorrow, but you can't really be worried about what's happening tomorrow. Almost everything we have in today's society is cycled. We've had oil crises before, we've had financial crises before. Almost everything is a repeatable thing, and we've lived through every single one of them, and if you maintain a long-term objective, you're probably going to do all right.
Ron and the team at Cozad Asset Management take a client-focused approach as they make every effort to satisfy the needs of their clients and to deliver superior results. Their objective is to build portfolios that meet the long-term financial goals of their clients, who are made up of individuals and families who desire financial services that are both personal and professional. Let Cozad Asset Management help you achieve your financial goals to provide you with peace of mind and security for your future.